HYLV, it's high yield, low vol. Almost like an oxymoron, or Diet Coke of high yield bonds, right? So it's aiming to basically capture the least risky, credit risk rather, area of the high yield market, right? So kind of logical. Low vol is popular in equities, why not bonds? 65 million, although a portion of that is from their own advisors. 40 basis points, about where JNK and HYG are. Let's look at the tail of the tape immediately, because you want to see how this compares to HYG, which is the big dog of the area. And here's another one from Deutsche Bank that's also low beta. So you can see this one's a little more expensive and a little more volatile than the Deutsche Bank product, but both are way less volatile than the HYG, you would hope. And look, this is the big thing. Double B, 74%, 77, 52. And so obviously you're also going to have a little bit of a lower yield. Let's look at the performance, not this year, they're all about 10%, but in Q4, because you think this thing should buffer, and it does. Luckily, you can see here that it lost 2.8% in Q4 when HYG was lost 4.4%, so you saved half. So Scarlet, I think that's when this thing's going to shine, is when there's a sell-off and people are looking for something with a buffer.
Yeah, it did its job then. Still with me is Kelly Yeh of IndexIQ. Kelly, isn't the point of high yield, though, to take on more risk and therefore get more yield? Because this ETF goes against that idea.
Scarlet, we are in a low yield, high volatility environment right now, and investors are really looking for tools to generate income but also manage the risk on the downside. So in 2017, IndexIQ came up with this high yield, low volatility ETF product, really trying to give investors a systematic way of investing in lower risk high yield bond. And the way we do that is leverage market-based information such as spread and duration. We have research show that a market-based metric is more responsive for the credit quality changes in bonds and usually lead rating agency actions by 20 to 30 months.
Now, we talked about passive aggressive and this shift to passive, Eric, and our colleague Nir Kaysar, who's a Bloomberg opinion columnist, recently wrote a column about how fixed income funds have been spared the shift to passive so far, but that's going to change. He says the industry has persuaded people they need an active manager to navigate bond markets, many of which are less liquid and more opaque than stock markets and less well understood by ordinary investors. And star managers still burn brightly in the bond world. Those selling points will soon evaporate, however.
Yes, so bond managers, in my opinion, have been very lucky to play against the ag, which I equate to the Washington Generals, the team that plays the Harlem Globetrotters, whereas the S&P is like the Chicago Bulls, right, in the 90s. It's full momentum. When will this change? You have products that are better and better, doing better things in the ag. When will they be benchmarked against these better ETFs and indexes that are being designed?
Good question, Eric. So when we think about smart beta or rules-based fixed income, we really think they're a way of active management by systemizing some of the best practices from active managers into rules-based format, and the benefit is removing some of the behavior biases. In that sense, fixed income and equities are really similar. But what's different from equities is they have been there for a long time, and investors have done a lot of education and research support, but furthermore, they have tools to allow them to really separate manager skills with access to systematic risk factors. I think fixed income, we're in the first inning, but we are seeing all those products coming out, which is really helping investors understand the drivers of fixed income return, and in the future, active managers will have a harder time to explain their return to investors.
So maybe playing a bit of catch up there. Let's shift to the alternative category, because you guys have the two biggest alt ETFs, but they switched places recently. M&A is now #1 with $880 million in assets, surpassing QAI. Why the bump up here? What exactly does M&A do?
Well, first of all, we're happy to not just have one, but two leading alternative ETFs on the market.
Bit of a shameless plug, but go ahead.
So QAI and M&A are doing different things. QAI is trying to target replication of the broad hedge fund benchmarks, where M&A is trying to give investors a systematic way of buying announced deals and try to capture the deal premium. For M&A, because of its low risk and high Sharpe profile, investors are not only looking for replacing some of the merger acquisition managers, but also looking at a way of using it as a fixed income alternative or using it as part of the equity allocation to de-risk.
And just real quick, how much potential is there here? You would think democratizing hedge funds would be a bigger hit. Only $3 billion. What's in the way?
So we actually have just done a research with Greenwich Associates, and the research shows for institutional allocation to alternatives, there's about close to $1 trillion allocation to liquid alternative products, out of which only 50 billion is in ETFs. And they forecast tremendous growth in the next few years. And the reason, as I mentioned before, like fixed income, smart beta products, investors need more education to that product. But furthermore, this is a market environment where people will see more volatility, and this is where alternative products will shine.